All right, let's dive right in. Today, we're going to pull back the curtain on one of the most essential tools in any stock trader's toolkit, the moving average. We're going to see how a simple line on a chart can totally change how you look at the market. You know that feeling, right? You pull up a stock chart and it's just chaos, a wild mess of ups and downs, spikes and dips. It's what we call market noise. So the biggest question is, how on earth do you find the real story, the actual trend hidden in all that static?
Well, the solution is actually pretty elegant. You take all that messy price action, all that volatility, and you smooth it out into one single clean line. That line, that's the moving average. Its whole job is to cut through the noise so you can see the big picture.
So what exactly is this line? Let's get into it and break down the two main types that you're going to see and use pretty much everywhere.
Okay, so a moving average is pretty much what it sounds like. It's just the average price of a stock over a set amount of time, say the last 50 days or maybe the last 200 days. And they call it moving because it's always updating. Every new day, it drops the oldest day's price and adds the newest one. Think about it this way. You wouldn't try to understand the climate by looking at one random Tuesday's weather, right? No, you'd look at the average temperature over the whole season. That's exactly what a moving average does for a stock. Now, there are two main flavors here. First, you've got the simple moving average, the SMA. I like to call this one the historian. It looks at all the price data over its period and gives every single day equal importance. It's slow, it's steady, and it gives you that really long-term view. Then you have the exponential moving average, the EMA. This is the trend spotter. The EMA is all about what's happening right now. It gives way more weight to the most recent prices, so it reacts a lot faster to changes. It's quick, it's responsive, but it can also get faked out by a sudden, meaningless price spike.
Okay, so we know what they are, but how do we actually read them? What is this line telling us? This is where it gets really powerful.
On the most basic level, you just have to look at which way the line is pointing. Super simple. If the moving average is rising, that's a pretty clear sign of an uptrend. The buyers are in charge. If the line is falling, you're looking at a downtrend. Sellers have the momentum. And if it's just flat, kind of moving sideways, that tells you the market is stuck in a range, just consolidating.
But here's where it gets even cooler. Moving averages don't just show direction, they often act like a dynamic floor or ceiling for the price. So in a healthy uptrend, you'll often see the stock price pull back, touch the moving average line, and then bounce right off it, like a ball hitting a floor. And in a downtrend, it acts like a ceiling, with the price trying to rally but getting smacked back down by that line.
All right, let's get to the good stuff. How do you turn these lines on a chart into actual actionable trading ideas? Let's walk through a couple of classic strategies.
The first and most basic signal is what's called the price crossover. It's simple. When the stock's price physically crosses above the moving average line, that's often seen as a bullish signal. It suggests momentum is shifting to the upside. And you guessed it, the opposite is true. When the price falls below the moving average, that's a bearish warning sign that a downtrend might be starting. Okay, now for the famous one. You've probably heard of this, the golden cross. This is a huge bullish signal for a lot of traders. It happens when a shorter-term average, like the 50-day, crosses up and over a longer-term one, like the 200-day. The thinking here is that recent short-term momentum is getting so strong that it's actually overtaking the long-term trend. It can signal the start of a major new uptrend. And of course, on the flip side, you have its evil twin, the death cross. Sounds dramatic, right? Well, it's a big deal. This is the exact opposite of the golden cross. It's when that short-term 50-day average crosses below the long-term 200-day. Traders see this as a serious red flag that a major long-term downtrend could be getting underway.
Now, it's really easy to get carried away with these signals. They seem so clear, but no tool is a magic bullet. And if you're going to use moving averages, you have to be really honest about what they can't do.
So here's the reality check. Moving averages are amazing for identifying the trend and cutting through the noise. But, and this is a huge but, they are lagging indicators. They tell you what has already happened, not what's going to happen. They confirm a trend, they don't predict it. And in a market that's just chopping sideways with no clear direction, they can give you a ton of false signals, whipping you in and out of trades. It can be super frustrating. So how do you use them the smart way? Well, first, always remember, they're a guide, not a guarantee. Second, never ever use them all by themselves. You've got to combine them with other tools, things that measure momentum or volume, to get the full story. For instance, a crossover signal is way more convincing if it happens with a big spike in trading volume. And of course, the most important rule of all, always use proper risk management. Always.
And this brings up a fascinating, almost psychological point about how all this works. Why do these lines act as a floor or a ceiling so often? Well, part of it is that it's a self-fulfilling prophecy. Think about it. Millions of traders and algorithms all over the world are staring at the exact same lines on their charts, so they all put their buy and sell orders right around those key levels, which, you guessed it, causes the price to react exactly at those levels.
And that leaves us with one last question to think about. When we're all looking at the same charts, using the same tools, watching the same lines, are we actually predicting what the market is going to do? Or are we all together creating what it's going to do? Something to chew on.